Hey team, welcome to episode 121 of Transition Talk, where we talk about dental transitions and how to navigate the sometimes messy path to practice ownership. In a dental practice sale, identifying what you're buying or selling helps you understand what you need to diligence and document as you move through the dental transition process. That's why it's so important for both the buying and selling doctor to know what sales structure is being proposed, the implications, both legally and financially, before taking this big step in the process. When it comes to partnership sales, there are a few additional elements to consider that are critical to the deal and your life as partners. We've already discussed asset versus stock sales in episode 40, but that was a long time ago. In this episode, we'll continue to help you determine what structure is best for you and dive into some more of the nitty-gritty. To help provide some additional insight on the topic, we have two very special guests joining me today. First, we have Cain Water's financial planner, Sarah Oliver. Sarah is a CPA and investment advisor representative. With her passion for financial education, she takes pride in sharing her specialized skill set with clients to help them make informed financial decisions along their journey. Sarah, welcome to Transition Talk.
Thank you, Christy, for having me. I could not be more excited to be here.
I can't wait. In addition, we also have Matt Mitchell. Matt is an attorney at Friday, Eldredge and Clark LLP, where he is a partner in the Mergers and Acquisitions practice group. Matt represents clients in a wide range of corporate and transactional matters, including entity formation and reorganization, corporate governance, mergers and acquisitions, security offerings, and commercial contract drafting and negotiation. He's experienced in handling the complex aspects of medical and healthcare law, and he has been a wealth of knowledge for both us and our dental clients. So welcome, Matt.
Thanks for having me.
Absolutely. Well, I feel so lucky to have you both in the room. Both of you are people that I know we can call whenever we have questions on either side of the house, and often do. So thank you for answering our questions and helping our clients as they go through this. You know, when we started thinking about this episode, we really started thinking about the fact that, I don't know why, but recently, at least on the NDP side, we have been seeing a lot of sales being proposed as stock sales and having to do a lot of education for our clients who are buying into these on why that's not a good structure or what the impact of that is. And sometimes we can get sellers to change the structure and sometimes we can't. And sometimes there's a reason for that and sometimes there's not. And so we just thought it would be really helpful to have both of you guys on to kind of talk about both sides. And you guys clearly have a wealth of knowledge in both your client bases and probably see a lot of varied structures. And so I want to give the listeners a quick overview of asset versus stock sales. So if you haven't listened to episode 40, you should certainly go back and do that. But while you're here, an asset sale is when you are buying the actual things that make up the practice, right? So you are actually buying the tangibles, so the things you can touch, the equipment, the supplies, patient files, the chairs, the computers, and the things you can't touch, right? The relationships with the patients, the goodwill, the intangible things of the practice. But you're not buying the actual legal entity. So you're basically scooping up all the things inside of the seller's legal entity, and you're plopping it into a new legal entity that you have formed. On the flip side, if you are doing a stock sale or an interest sale, right, you're essentially buying the interest or the stock of the seller's existing entity and everything in it, right? So any liabilities, any cash, like you're basically saying, okay, you're going to give me your entire business, good, bad, and ugly. I'm going to take that over. And there are certainly some kind of administrative, I wouldn't say pros, but administrative eases of buying a legal entity versus kind of the assets and setting up a brand new entity. But, you know, just like everything else in life, nothing's that straightforward. So I wanted to dive in and ask you guys some questions about this, and clearly anything else that's kind of on your mind on this topic. My goal is that when a listener leaves this episode, they are fully informed on the topic. So Matt, I want to start with you. What's the most common type of sale in the dental acquisition/partnership space, and why is that?
Yeah, so I would say the most common sale is an asset sale. But the way I usually think about it is there's really two types of ways to classify sales. There's the tax implications, and that can be a equity or asset sale, or the state law implications, which also can be an equity or an asset sale. And from a tax perspective, you can have an equity transaction that's treated like a asset sale and vice versa. And so sometimes they're combined together and people talk about them as one, but really you can have an equity sale from a state law perspective, which is contract assignments, and like you said, Christy, what's
Mhm.
being sold that's treated like a asset sale for tax purposes. So asset sales the common type, but there are some reasons why you have an equity transaction that may be treated like an asset sale for tax purposes.
And why do we see more of the asset sale or the equity sale that's treated like an asset sale? Like, what is the main driver of why that is the most common type in dentistry?
Yeah, so I think the driving force oftentimes is the tax implications for the buyer. The buyer can deduct or amortize the purchase price.
Hmm.
And the comparison in a traditional stock sale is that the buyer holds stock basis just like they would if they bought a marketable security. You sit on the stock basis, you can't depreciate it, you can't amortize it. And if you are using debt or just from a cash flow perspective, the buyer's always better off to get some deductions, which Sarah could probably talk about
Yeah.
better than me, but get some deductions for the price they're paying.
And do you see a difference in the sales structure, or is it more often asset versus equity if it's a partnership versus a walkaway sale? Or is it always X if it's a walkaway and more evenly split, maybe if it's another type of sale?
Yeah, that's a good question. So I would say a walkaway sale is more likely to be an asset sale. In a partnership transaction, you may have an equity sale that you still may have tax treatment as an asset sale, but you may be more likely to have it as a somebody buying a membership interest or a partnership interest. And there's some reasons why, from the dental space, you have some billing issues, you have assignment of employees. There's some reasons why it can be more streamlined to be an equity transaction. And so sometimes that's an important factor in trying to structure this transaction.
Yeah, and I definitely want to talk about that because that's a main point. But Sarah and Matt touched on some of these, but talk to me about the Cain Waters methodology and the structure that is preferred by you guys and your teams. And I'm assuming most of your clients kind of fall in this structure. And talk to me a little bit about why that is the preferred structure.
Yeah, absolutely. So I would say Matt sees a wider variety of outside sales. On the King Waters end of things, we typically see an asset sale. And so we like to do our structuring that way. That's kind of our recommended model for that exact reason, the tax deductions, which I can talk more about too. The couple that I have seen be stock sales are what I'll call outside clients coming in with either already having made their buy into their practice or already down that road significantly too far to change the path they're on. So that's typically when I see stock sale, and I have a couple of clients that fall into that boat as well.
Yeah, I think from my perspective, typically when I see a stock sale and a partnership, it's like a multi doctor partnership that has been structured like that from the moment the first person bought in 25 years ago, and they're not willing to change it. And this is just kind of how they've done it, right? I mean, that's typically kind of the ones that we
Yes.
see. Or you see someone who has structured it that way because that's just how they think that you do it. Like there's no kind of reasoning behind it. It's just like, oh, you want to buy my business, you need to buy the stock or you need to buy the interest or equity. And so, yeah, so I think that's an important component. What are the legal implications of kind of the two types of sale, right? Like asset sale, meaning I'm going to create this new entity and kind of put the assets that I'm buying there versus kind of buying the entity. What are the legal risk or legal implications of each type?
Yeah, so it's easiest to talk about this in a walkaway context. So in a walkaway context, which is,
Yeah.
one seller, one buyer, no crossover. In an asset transaction, the seller is, like you said, Christy, transferring all the assets, but also transferring the employees. So technically the seller's firing all the employees and your buyer's rehiring all those employees. Your buyer is getting their new EIN, new billing. And so all those things are restarting with the buyer. In an equity transaction, that's transferring over. And so the practice itself has more continuity from a billing and an employee standpoint.
Got it. And then are you taking over, if I'm doing an equity sale and I'm buying someone's entity, am I at risk that like their history
Yeah.
is going to come back and haunt me a little bit?
So yes, that's right. So in an asset transaction, your buyer typically would not be assuming liabilities of the seller. Now there are some exceptions. There's certain taxes, there's certain state
Hmm.
laws where you could have successor liability, but for the most part, in an asset transaction, your buyer would not be assuming the liabilities of the seller. Whereas in an equity transaction, those liabilities, really all liabilities, would carry with the entity itself. Now, your buyer itself may not be liable, but the entity will continue to be liable for its obligations and liabilities.
So from a operational standpoint, I'm sure there could be language written into agreements and indemnifying them of anything and kind of saying, hey, this isn't going to be your responsibility. But operationally, I'm assuming that's still kind of a hassle, right? For the new buyer to have to kind of navigate that if something were to come up, even if it wasn't their responsibility. because they're still the owner, right? So they're still having to figure out how to handle it to keep the goodwill of the practice, I would assume.
That's right. Yeah.
And then, Sarah, from your perspective, if we talk about partnerships in particular, clearly, if I'm buying into a partnership via asset sale, we have the deductions and we have the ways we can write it off. What are some other financial things we need to think about if we think about buying into an entity in a partnership versus kind of having our own individual entities and kind of creating an operating entity, kind of a triangle structure, which I know we've talked about here and you guys love?
Yeah, so I would say with the entity takeover, buying into an entity, you do need to be careful of the exact things Matt mentioned, which would be employee liabilities. That's one of the number one liabilities sitting out there for any of our practice owners. Something goes wrong with payroll or time off calculation, that can really come back to haunt you as a buyer and is not something that you want to deal with. So I would see definitely the brand new fresh entity being the priority. However, if you're buying into a partnership, you don't have that luxury and you might have to buy into the existing practice entity that carries on. So I would say the employees being a huge factor, a 401k plan, another huge factor. If there's a 401k plan out there, there's liabilities related to that 401k plan and how it's been operated. And so that can be an impact of something you want to be aware of buying into a partnership. Another big financial aspect is debt. So are you buying into and becoming a party to the debt in that existing entity? If so, is your purchase price being adjusted for that debt? That's a big one. So that would be buying into kind of that top triangle of our triangle of entities that we recommend here at Cain Watters and at NDP. Our structure and how we do things with the partnership kind of at the top owned by individually owned S corporations really helps from the tax side because you can put the assets at your S corporation and take those very good tax deductions. You're still becoming a party to the partnership entity, but there's hopefully less debt outstanding in that entity, maybe less liabilities. There's still an employee liability, but maybe some less complications in that entity, and you can still structure your S corporation how you would like to. So we like that method for a couple different reasons, but kind of buy into that liability piece. You can structure it that way.
Matt, on the debt component, which Sarah mentioned, if I am a buyer buying into any type of practice that has debt, clearly there's hurdles abound there. But if I agree to do that and I'm not agreeing to take on the debt payment, what do I need to do to make sure that legally I'm not required to pay that? Or is that not a thing? Am I always going to be legally required?
Well, so yeah, so it's a good question, and it partly depends on the structure. So, do you have upper tier entities that just the doctors own? Who are the borrowers of the debt? Is it at the
hmm
practice level? And so some of that's just the diligence of the
Right.
process to make sure that you know exactly where the debt is. And debt, I think Sarah can attest to over the past couple of years has been an interesting area because of just interest rate changes where people may have an old rate that they love and they don't want to disturb. And so there's maybe a reason to not try to change the
hmm
structure because you may give your bank a reason to come back and try to renegotiate a rate. So that's been an interesting area. So back to your question, there are ways, especially if the debt's not in the practice entity, there are ways for the buyer to not assume the debt. That's can be fairly easy. If it's in the practice entity, the buyer would, in a sense, be in a partnership context, would be buying into that, and you really would have to have some contractual agreement within the partnership to say that your buyer is not going to be responsible for debt service payments because they sort of are automatically by default, and so you would have to have something layered on, and there'd be some risk for the buyer if the bank, come and try to assert some claims against the practice.
Yeah. And I think that's what we hear buyers not fully grasp that, right? Like they're like, oh, well, I'm not going to be responsible for making the payment. And they said that we can add documentation in the agreement saying that I won't do that, which both of those things might be true. But if the practice were to default on it, the practice itself, which is the thing you're buying into, which is the thing you have value, is now at risk, right? Unless you're a really good attorney, Matt. I don't think we can paper that away, right?
That's right.
So that's important. And that leads me, that's actually a very good segue into partnerships in general, right? I want to stick with partnerships in this section. What document, Sarah, would you consider the most important document if a buyer, and let's just talk a new partnership, right? And buyer and seller are going to be creating a new partnership. The buyer's buying into it versus asset or equity, and now they're creating a new partnership. What legal document have you found to be the most important in this part of it?
Yeah, so I kind of think of there being two sets of legal documents. There's one set that is the transaction itself. And so that is generally, I say a set of documents because it generally has multiple documents within it. And that's where I lean on Matt as an attorney to help guide us because there's sometimes 10 documents accomplishing a transaction. Those are very important and critical for many reasons. But the most critical is actually your partnership agreement, or also called an operating agreement. That is the document that guides your ongoing operations over time. So how do we make the money? How do we split the money? Who has management responsibility? Mm-hmm. This also might outline potentially some liability issues as well that Matt's talking about. But that ongoing operations and how you and your partner want to work together is really the guiding document. The point in time, again, kind of fades away. Once you're 10 years into partnership, we don't reference those documents anymore. We reference the ongoing operating agreement. So what's really most important in there is how we make money, how we split money, and how we operate together. If you're a specialist or a pediatric who handles on-call, I mean, this is your chance to work with your partner on how you are going to work together. I see buyers really anxious and excited to get into partnerships, and we love that here at Cain Watters and NDP. We love ownership. We scream it from the rooftops that you should own a practice, but some buyers are so excited to get into ownership that they don't do their diligence enough and they don't read that operating agreement, or there's something in there they disagree with, and they're not having those conversations up front with their partners. And that, I think, is really the most critical about partnerships moving forward.
Matt, we see this a lot when we get operating agreements from others, but I'm interested in your take. What are the most common errors or omissions or mistakes that are made as people create this very important document that's kind of going to govern their life as partners that you see?
Yeah, there's a lot there. So I'll do my best to pick out some. I mean, I always think, hopefully you never have to look at it, which is what we all say, but sometimes good fences make good neighbors. And you think about the way that everyone's incentivized to act to make money and do what's in their best interest. And so I think the goal of the partnership agreement is to try to create the right incentives in place. So my incentives to make money and to act in my interest are really in furtherance of the partnership, and that we don't have really misaligned incentives between the partners. And so I think the biggest set of problems exist when you don't have a partnership agreement that is thinking through what happens if we have misaligned incentives. Because hopefully your partner's a great person and you don't have the problem, but problems exist. And so I think through ownership and how ownership changes, what happens if somebody wants to produce more or slow down. So those sorts of areas where everyone goes into the transaction thinking things are going to go great, but life changes, people end up in different spots in their life. And if you haven't thought through, what happens if this doctor's on the backside of his career and doesn't want to work as much, are they incentivized to continue to hold on to ownership, which is maybe great for the young doctor that wants to get more ownership and they want to produce more, and thinking through how that works for moving forward.
Yeah, and if I can, I'll jump in. I think that's one thing we do really well here at Cain Watters is we sit our new partners in a room together and we talk through, like, this deal works great right now, but what are the potential pitfalls you might have in the future? What if production changes? What if someone has a baby and needs some time off? What if there's a different family event you need time away? That's what we force our clients to talk through in the room with each other, and that's what builds their partnership agreement. From our meeting, we send information to Matt so we can build the document for them so that we're talking through and having those hard conversations on the front end. God forbid a partner dies or has a disability. These are really important things that could happen to your business partner, and you need to know how to handle those. So we handle those conversations on the front end and really build that into our document and force our clients to talk about, what if something goes wrong? What if we just disagree? What does that look like? We make the joke at Cain Watters that we're entering a business marriage, and you really have to have those front-end conversations before you enter that partnership together.
No, yeah, I think that's so important. We do something similar at NDP, but I think it's, hey, this clause is there to protect both of you. And while one of you may be more likely to maybe need it first or be kind of subject to it first, depending on age and where you are in your career, at any point in time, I mean, all three of us have seen something that comes out of left field, a disability or a midlife crisis this, or, something that you don't anticipate when you are kind of entering into this business marriage and things are rosy. And so it's kind of playing devil's advocate to be able to kind of think about the worst case and come up with something before you're in the middle of it. Because when you're in the middle of it, it's not so,
It's a little bit messy.
It can be messy. Yeah, that's true. Sarah, you mentioned something that I want to kind of touch on because it goes back to the structure. So how you split money, how you pay yourself. We've talked on the podcast here before about making sure there's a portion of what you get paid that is kind of eat what you kill, or, what you produce, or kind of based on your productivity, and then a piece based on ownership. The structure can impact that, right? So if we talk about, if I'm buying equity, so I'm buying in, so now we're individuals and we own one entity, versus what you were talking about where we each own our own S Corp and then we together own an operating entity. How does that change compensation tax-wise, financially? How does that make it more or less complicated if you own one entity?
Well, one entity can be complicated no matter what, but it especially depends on the type of entity that is. So if that entity that you own jointly is an S corporation and you have two doctors inside of that, tax law says you can only split distributions in an S corporation based on ownership. So if you are 50-50 partners, you have to distribute out of that entity 50-50. Now, you can differentiate a little bit with wages, but then defeats a little bit of the tax planning purpose of the S Corp. So there's a couple little ways around that. If that's the structure you're in, come talk to us. But the entity that we prefer for two doctors to be in together is an LLC or a partnership that files a Form 1065 on the tax return. And that allows for what we call special allocations. That allows for distributions to not tie to your ownership. So you're 50-50 partners in an LLC, one partner does 60% of the production, maybe they can receive 55% of the distributions from the entity, and the partner doing 40% receives less. So it allows you to allocate based on something that's not really a financial number, but to allocate based on production, which in our dental practices is so important. That, Christy, allows us to have the differentiation between you can be paid a little bit on production and a little bit on ownership. And that allows kind of smooth transition. It allows flexibility in production numbers throughout the year and over the years as those change and fluctuate. So we really like two doctors owning together to be in a 1065 or essentially a partnership.
Got it. And then Matt, my question for you is, if we get the structure wrong initially, right? Like we weren't educated, we didn't know, we didn't do our diligence, and we bought in and we did it in a structure that maybe doesn't make sense for us or is just messy financially or legally. How often does it happen that someone comes to you and says, we need to fix this? And how much harder is it to do it then than to do it in the beginning? Because you mentioned some administrative kind of struggles if you do it kind of the quote, quote, right way on the front end. How does that compare to fixing it on the back end?
Well, it's a significant burden to try to have to fix it on the back end. And the most common structure we see is a joint S Corp, so multiple doctors in a single S Corp. And those are particularly tricky to fix or to get into a structure that Cain Water is just looking to get the practice into. So it's possible, but there are some limitations on when we can do it, how we can do it, and there's some risk associated with it. And so it's just not terribly easy. And what can happen is you perpetuate in the structure because of some timing rules. And so especially if you're continuing to add new partners, you just keep in the structure. You know you want to get out of it, but you can't really get out of it. And so it can be tricky to get out of it once you're in the structure.
So one of the gripes, I guess, we hear on our side is that multiple entities, more costly, more accounting costs, more tax costs. Now there's more legal costs. What I'm hearing from you is that while that is true, right? Like factually, you're going to be paying for multiple entity accounting, multiple entity tax. You are going to have the administrative uncomfortableness of new EINs and new kind of vendor relationships. What I think I'm hearing, correct me if I'm wrong, is that it is worse and more costly and more time consuming to try to fix it once you're kind of in it. And maybe something some people even can't fix depending on their situation.
Yeah, exactly. Yeah, I would say, and just from a tax savings perspective, I think more often than not, the additional costs, administrative costs that you're talking about would be outweighed by the tax benefits of being in the correct structure. And so, although it is a little bit of a headache on the front end, that it would be outweighed by the tax benefits over the life of the partnership. Not to mention just the structural benefits, of the partners themselves and making sure we have all the incentives aligned right, the partnership agreement like we want it. So I think that there's major benefits to the partnership being on the correct structure.
This is one of my questions. I'm going to throw it to you first, Matt, but I feel like the less you can give each other something to argue over, right? Like the less things we can kind of eliminate from those ongoing discussions, the better. What you run through for tax purposes versus what my partner runs through, and kind of you're super aggressive and I'm super conservative. That happens all the time. I mean, we're all humans. We all think differently about taxes and, what's gray and what's not. And so I think kind of removing that by kind of allowing this separated structure can be really helpful. So my question to you, Matt, is what are the top 3 things that you see partners argue over? And kind of, I'm sure you have repeat customers and customers that call you after the fact and ask questions about that agreement they put in a drawer.
Yeah, top 3. Okay. So I'll try to list them by number. So I'd say number 1 is changing ownership percentage. So going up or down in ownership percentage, I think is number 1. So you're already partners and one person wants to go up in ownership or, go down in ownership. So that's usually it's going up in ownership is the problem. So that's 1. 2, admitting new doctors, admitting new partners, or maybe hiring an associate. So adding either a new doctor or a new practitioner to the group. And then 3 would be selling altogether, selling to a DSO or selling the practice. So I think that would be the 3rd.
And so when you're not involved in creating the agreement, because clearly if you're involved, the agreement is very clear on what to do. But let's say someone comes to you and says, hey, I need your advice. What do you see most often missed that make those 3 things challenging, right? Like what is not in the operating agreement maybe should have been that might have helped alleviate some of that discussion? Clearly not all of it, but some of it.
Yeah. So just recently had some situations where it made me think about this. So the first is, so Sarah mentioned this ownership component before. This is just an example. If you don't have an ownership component in the practice, I think there can be a tendency for a doctor to say, well, I'm just paid on my production anyway. So what does it matter if I admit this person to the partnership? I don't have an incentive to do that. Or you may have multiple doctors and one may want to add somebody, but one may not want to add somebody. And so if you have things like this ownership component, I think it can create a structural reason for everyone to say, yeah, let's admit this new person because we're all going to benefit. Or, the other situation, which is somewhat similar, is if you have some sort of sweat equity situation, it can be even worse where one person's admitted and then once they're admitted, they're thinking to themselves, well, I don't want to admit any more sweat equity people because I'm not going to benefit from that. Once you're on the other side, and this kind of goes into the whole kind of Cain Waters theory, is once you're on the other side, you're now a seller. Yep. So your situation as a buyer has changed to a seller. And if it's not equal, you're in a situation where you're significantly better on the seller side than the buyer side. And sometimes that can create some strange outcomes.
Yeah. Sarah, what about you?
Top 3 things. I would say definitely I mirror what Matt said. The ones that I've seen recently are how to split money, I think is always an argument, and that plays into the ownership percentage, buying up or down. That plays into our split methodology. Little intricacies within that, like is it gross production or net production? Are you including write-offs or not? Things like that I definitely see arguments over and people referencing their documents and pulling them out of the drawer. The other one I agree with selling or kind of a big strategic move. Like should we as a pediatric practice admit a general practitioner? I've seen a lot of partnerships argue over items like that and kind of how to move forward strategically. And I think that is very hard to write into a document, and really we can't. So a lot of times Cain Waters is coaching their clients on how do you have this conversation with your other partners and how do you guys agree together how to move forward? Because we can't necessarily solve that puzzle for you. The puzzle isn't solved by the legal agreement. So how do you guys approach the decision logically and talk through it with your partners to come out on the other side?
Yeah, and that brings up the decision-making factor, which I think is really important. That should be something that you talk about in that operating agreement of at what level is there maybe that it's majority versus all have to agree? What types of decisions, do you all have to agree versus a majority of you depending on the size of your partnerships? When you're talking 2 people, it's easier. When you're talking 8, 9, 10, that becomes more challenging to get that many people to agree. Okay, 2 final questions. I'll ask them both. You can kind of think on your answer. 1, did we miss anything, right? Like if you had to kind of think back on what we've talked about today, we had some good conversations and I know I had a lot of questions written out here, but was there something that we missed that you think is important as we talk about structure and kind of how to assess what a good structure is? And then the second one, hey, if you can give the doctor listening one kind of piece of final advice, if they're thinking about walking into ownership, whether it be a partnership or a walk away from both of your perspectives, right? Both legal and financial, what would that be? Okay. So we'll start with the what did we miss question first. Matt, I'm going to throw it to you on that one first. Anything that we missed that you feel like is really important as you're considering structure in a sale and kind of what to think about?
Yeah, well, we touched on it, but just to go back on the asset versus stock sale, I think a lot of times people have a misconception that as a seller, a stock sale is better.
Hmm.
If someone's told them along the way, "Oh, I'm a seller, so I want a stock sale," and it's capital gain, so it's all capital gain. So from that standpoint, there may be some truth to it, but I think it's short-sighted a lot of times
Hmm.
in a partnership context, where there are a lot of reasons why, even for a seller, you may be better in the end to have an asset or some sort of asset like transaction. And so I think that for the seller to really think about the whole picture and what the total global picture looks like, and a lot of times it's a misconception that can be harmful ultimately for the seller of the practice to just focus on whether they're selling stock at a capital gain rate.
Yeah, it's simplifying a very complex thing that you need to look at from a
Right.
bunch of different angles. Yeah. What about you?
I would say one thing we kind of missed is just talking about a small partner entering a big existing
Mm-hmm.
partnership. And this is what I've seen in my client base recently is a partner being admitted at maybe a 5% or 10% where they're joining 4 or 5 doctors existing already. Maybe there's one senior doc who's been there a long time that's still retaining a 50% ownership piece. And they're kind of admitting this kind of junior partner.
Mm-hmm.
I think that is really, when we talk about structure, asset sale, stock sale, it's very easy when you're doing a walkaway or you own 100% of your business.
Mm-hmm.
Where it gets complicated is these partnership groups. And the bigger the group, to your point, Christy, the harder it is to manage. And so if you're out there looking or considering an option to buy a 5% ownership stake or a 10% ownership stake that's small relative to your partners, you have to navigate this partnership agreement that's already probably written.
Mm-hmm.
So we're not writing this thing from scratch, and you have to take that existing agreement. You mentioned this in one of your diligence episodes, and you have to figure out what's already in there. What have these 4 partners already agreed to that I'm going to be added to? As that kind of junior partner buying in, you don't feel like you have any power to negotiate that, and you may not have any power to negotiate that. The partners may say, here's the deal, take it or not. So I have one client example where he's in this situation and he took on a pretty large buy-in note. He bought in as a stock sale. So that was one first error. This was before he came to me. Now we're trying to navigate it together. And he has this one senior partner that kind of sets the rules and he doesn't have a lot of say. So I'm helping to coach him on, do we go back and renegotiate this? Or he's considering exiting. He's like, I don't know if this was the right practice for me to be in. And so we're navigating that together right now. So one thing I would say is this is maybe one of the misconceptions or the biggest piece of advice I would give is while we talk about ownership is key, and I always still believe that, the right type of ownership is key too. And being in a partner group where you feel heard and that you feel like you have an opinion, and even if you're only the 5% or 10% partner, that you have some say in how this sale goes down and how it works moving forward. If you have things to say on that, your partners aren't listening, this might not be the group for you. And you might need to look at the other opportunities that are available. So I just want to encourage everyone to buy and own their practice, but to find the right fit for them. And it's not necessarily your first opportunity either.
Yeah, no, I think that's so important. I mean, I think that the resentment that will build up over time, right? You think you can just kind of let it go and it's fine and it's just how that person is. And I really want ownership and I really want to do it right now. And so they're excited and they get in and then they, over the course of 2, 3, 4, 5, 7 years, it's like, ugh, like I thought I could get over this and I can't. And now it's kind of making small things big things because of that lack of voice that you have.
Yeah, and a lot of it too is the structure he was put into was really not the right structure. It was a stock sale. He didn't get the benefit of those deductions, but he still has a really large practice loan. So on the CPA side, that's not a good thing. And so I'm helping him kind of figure out, is he being compensated fairly enough in this partnership to where he feels like he can continue? Can he try to affect change with this partnership group? Or should he look at exiting and pursuing another opportunity? So that's just one recent client example I've run into that I think is super important to know and talk about.
Yeah, absolutely. Matt, final piece of advice or wisdom you can share from the legal side of the house?
Yeah. So I would say, well, obviously hire good people
Mm-hmm.
to advise, but equally important is the doctor's a participant and the most important participant in the transaction and, strive to understand what's happening, take some ownership of what the process is. And you're not going to know everything. And that's why you got to hire good people. But we always get uncomfortable when people don't really seem like they either understand or have a desire to understand what they're doing. And I think it's important for doctors to really take ownership over understanding the process And I think ultimately, this is a critical asset, critical part of their life. And so it can have major implications, like, Sarah just mentioned, on these people's lives. And so talking with your advisors and making sure you understand what's happening. That would be my piece of
No.
advice among anything else.
I think that is so, so important because I too get nervous when I hand over legal agreements and we're like, okay. And they're like, yeah, anything you want to point out? And I'm like, nope, we're going to read. I know it's hard. A cup of coffee, a highlighter, tell me what you don't understand and let's talk to the attorney about it. Cause I just think that you're right. Like it is not their expertise and it should not be, right? I mean, that is why we all exist and that's why we're here, but it is the document and it is the life that you are going to have to lead, right? Like when that's all said and done, me and Sarah and Matt are not in your partnership day to day. We're not the one who's working and double the amount of time, but only getting paid, 20% because that's what our agreement says. And that's what we agreed to, not really understanding the complexity and kind of the magnitude of that decision. So 100% read your agreement. Guys, if you're listening, I'm hoping have heard the complexity that goes into each and every transition, right? Like Sarah said, if you are an individual buying 100% of a business, that is probably the most straightforward or should be the most straightforward. But partnerships can get really complex. Like what type of entity, what state, how many partners, kind of what specialties exist, what debt exists, what real estate exists. There's a lot of things that kind of create a web in these transitions, and understanding what you are getting into and how you get out of it and how you will operate in it is incredibly important. We've talked a lot about things. If you're listening and you happen to be in, Texas, please don't just create a partnership because Sarah on Transition Talk said it or Matt said something. Please call us, either Matt or Cain Waters, Sarah, myself, because you need to get some unique and individualized advice based on what you are trying to create either by yourself or with your partners. Sarah, Matt, thank you guys so much for being here. It's fun and educational.
Yeah, thanks for having me.
Awesome. Well, team, that's all we have for today. Thanks for joining us on episode 121 of Transition Talk. If you're looking for more on sales structures or operating agreements, be sure to check out episode 40, Asset versus Stock Sale, and our blog, Asset versus Stock Sales in a Dental Transition. We've also got some great episodes on operating agreements and partnerships and how to have some of those hard conversations. So find a resource, give us a call, and as always, make sure to share the transition love with those who may not know of us yet. And of course, subscribe wherever you listen to your podcast. Until next time.